Well, welcome everyone who's joining the call. We appreciate you on here. I think we have some representation from a variety of states already across the middle of the country. So that is wonderful. We're going to get a great update today. There's a lot to talk about. We have a full packed hour, which will be really good for all of us. Well, welcome to our update that we have for family businesses and those who are interested in what's going on in our political and legislative world in the United States. We have a great update today. I'm Stephanie Larscheid, the Executive Director of Prairie Family Business Association, where we serve family businesses who are working to thrive for generations, ranging from first generation to sixth generation. We serve family businesses where they are. We meet them where they are. We're headquartered in Sioux Falls, South Dakota, and we serve 267 businesses in a variety of industries. And so, what we're going to hear today is relatable to all the families that we serve. We're very happy to have Family Enterprise USA here to give us our update. We have Russ Sullivan, John Gugliada, and Pat Soldano, and they are experts in advocating for the issues that need to be heard and listened to related to small businesses across the country. And they have the voice in Washington, D.C. So we're very happy to have Pat, John, and Russ. I will turn it over to Pat. If you have questions, feel free to type them in the chat, or you're welcome to come off video and audio and ask your questions. You have these experts for the next hour. So ask any and all questions related to what's going on, what is to be expected, what the scenarios are if this or that happens. I'll turn it over to Pat. Thank you, Pat.
Thank you so much, Stephanie. I really appreciate this opportunity to talk to your group today. So as she said, we're going to talk to you about what is happening in Washington, D.C. We're going to talk a little bit about the elections, of course. But this is your speakers for today. I'm going to give a brief intro into the two companies that we are representing today and some background. And then I'm going to turn it over to John Gugliana, who is Director of Family Business Engagement, who's going to give you the results of the Family Enterprise USA 2024 annual survey. And then Russ Sullivan, who is a shareholder at Brownstein, is going to talk to you about the possible election results of 2024 and what we see on the horizon for 2025. Because most of you know the TCJA, or the last tax bill, has a cliff coming at the end of 2025, and all those tax provisions that are dramatically going to affect you as family businesses are going to expire. So he's going to talk to you about that. So let's get right into it. So Policy and Taxation Group is an organization I founded in 1995. It is the voice of family offices and successful individuals in this country. It's very synergistic to the work that we do with Family Enterprise USA, which promotes and advocates for generationally owned family businesses and their lifetime of savings in Washington, D.C. at a national level. It's important that you know we represent all sizes of business, small, medium, and large, in all industries. So we're different than your trade associations that you're probably part of because we represent all industries. And more importantly, we work on those issues that affect you as family business owners. The trade associations work on those business issues for you, and not that there's not some overlap, but typically we work on issues like income tax rates, because we've learned that 80% of you are pass-through entities, or estate tax, because families pay estate tax. 199A, that pass-through legislation. Those things that affect the bottom line of the family owners themselves. We are a 501c3. And why family businesses are important in America is because there are 32.4 million of you, and you are 87% of the businesses in America. You have a loud voice, you need to use that voice, and you need to help us let you use that voice. So 83 million jobs is what you create in this country, 59% of the workforce, and 54% of the GDP. So family business is big business, contributes $7.7 trillion to the annual GDP. So it is very, very important. You are important, and let us please be your voice in Washington, D.C. Now I'm going to turn it over to John Gugliana, who is going to talk to you about the Family Enterprise USA Annual Family Business Results.
Thanks, Pat. Appreciate it. Thank you, Stephanie and Peter and the team at Prairie. We appreciate you, and we're a fond sponsor of the work that you do there. So we appreciate this opportunity. So this year we had about almost 800 respondents from 40 states, which is truly a terrific number for us. It was only maybe 2 or 3 years ago where we were shooting for 150. So we're really thrilled where we are. I'd like to thank EY. They had stepped up as a Platinum Plus sponsor for the survey this year. And I'd also like to give a big shout out, obviously, to all the family business centers. There's Prairie right in the center there, that have helped us. Without your help, we don't get this work done, and we don't have a survey, frankly. So thank you to everybody. And also I'd like to thank the trade associations and the sponsors that helped us as well. So with that, we can get right into it. With the first two questions in the survey, we want to make sure we have the right people taking the survey. So as you can see from the first slide, you've got over 85% of them are majority or sole owners of the business. So that's already a good sign. And then with the second question, we want to know, what's your position? And again, over 91% of them are either the CEO or some executive level. So we're pretty confident that we have the right people taking the survey. And then we said we jump right into it, which is a very important issue for Family Enterprise USA, is how do you hold your ownership? And you can see right there, many of them are S Corps, LLCs, or what we call pass-throughs. That's why FEUSA puts so much time and effort into following tax legislation and including, as Pat said, the expiring TCJA benefits as well as 199A. Our last caucus meeting of the year will be focused on pass-through entities, and that'll be on September 18th. If anybody is interested in attending in DC, please reach out. Happy to discuss what's going to go on that day. We also, this is a question we've never asked before, but we're happy with the result. We suspected that many of our families were using trust for their planning purposes. And as you can see, you've got 75% said they use trust. So I know Pat always is pushing, make sure you're doing your planning ahead of time. Today is the right day. Don't wait for tomorrow. We asked about principal industries, and you can see our top three buckets are manufacturing, construction, and real estate. Agriculture, which you hear a lot about in this country, farming, especially probably out your way. We never want to pass this slide up, and I know Pat will never pass this slide up without mentioning that the industries you see at the top of the chart there have the same illiquid nature of their assets as farms do. So we have to constantly remind lawmakers of the fact that that is the case, that their assets are illiquid. It's a great slide, probably something that I'm sure anybody in the family businesses should be proud of, which is that, you got 81% of them are been in business over 20 years. And then you've got 40% of them have been in business more than 50 years. So again, the stability provided by family businesses is just tremendous. This is a unique question, obviously, for family businesses, is do you have generational employees? 70% said yes. Pat and I travel around the country, and more than once we've been in rooms where the owner will say, well, the grandfather, the father, and the son all worked here over a series of decades. So very unique to family business. We've learned through our work that family businesses offer great jobs for the community, but we've also learned that they give locally. We've seen this number be as high as 70%. So we've learned that, you are the ball field, you are the Boys and Girls Club, and we do not miss an opportunity with lawmakers to make that connection to the community. So we're always letting them know how the family businesses are tied into the community. This is the first year we've ever asked this question. Do you have a family office? I think as we travel the country, we're seeing the definition of family office be somewhat fluid. I think it's changing, but we'll continue to ask questions along this line. Then we asked if you have one, is it a single family office, multiple? As you can see, most of them opened it for their own purposes. Again, what'll be interesting in the next year or so, if we keep asking these questions, is, how many of these that were opened are now part of the operation, they've been opened inside the business. And here you can see what functions they perform: bookkeeping, bill pay, admin is mainly the big number there. I think what you'll see is an increase in the investment part. I do hear a lot of family businesses giving or talking about alternative options for their next gen to get involved without entering the operating entity. Pat, would you like me to turn it back over to you for some of the economic?
Sure, John. Happy to talk about that. Sure. So as you can see, the gross revenues of our family businesses, while 40% of them are on the smaller side, 1 to 5 million, most of them tend to be on the medium to larger size. And if you add up the red percents on the screen, you'll see that 15% of them, in fact, have over $100 million a year in revenue. So when we talk about family business, it's very important we talk about not only small business, but small, medium, and large, because medium and large are just as important as small businesses. They've always, and every time we ask this question, we get this kind of result. They pay better than non-family businesses. 46% of them pay above average in terms of wages and benefits. In terms of the policy, the top tax policies for them in 2024, the top 3 was, first of all, income tax, and then estate tax, and then you can see payroll tax. But you can also see that wealth tax, and this again, wealth tax wasn't even on the screen last year. We didn't even have it as an issue. So what's concerning is wealth tax is more of a reality today than it's ever been. So, and this is because it's now getting real legs, and Russ is going to talk about that. But you can see that income tax has gone down from 2023, and so has estate tax. And that's probably because we've got this 5% of the respondents telling us that wealth tax is their #1 tax concern. We've had businesses tell us that if there is a wealth tax imposed in this country, their business will be sold. There will be no other recourse. In terms of the economic policy, I put 2023 on the screen because I want to compare it to 2024. And you'll see that #1 was reducing income tax, and then estate tax, and then simplifying the tax code, and then reducing the deficit. But this is 2024. Look at the flip. The #1 economic priority for family businesses is now the deficit. They're very concerned about it. And I continue to say, I think because family businesses know how to run a business, they know what debt does to a business. They also know what it does to this country. And then income tax is second. Again, as John told you, 80% of family businesses operate through it as a pass-through. So they're paying 37% in income tax, and corporate America is paying 21%. And then reducing regulation, and then the estate tax is #4. We have never asked this question before either. We asked, if you had more money, what would you do with that money? And 52% said, I would invest more in my business. And while this isn't appearing on the slide, then the 30% says, I would pay my people better, more wages and more benefits. So this is really important for members of Congress to know, because they all think that if you paid less in taxes and had more in your company, you would distribute more to yourself. And as you can see, only 8% said they would distribute more to themselves. So the reality is, if they paid less in taxes, they would have more to invest with their employees and into the business themselves, and also into the community. So now I'm going to briefly talk to you about the Congressional Family Business Caucus before I turn it over to Russ. Before I get into this, Stephanie, is there any questions in the chat or any in the Q&A so far?
Not yet, but feel free to pose your questions in the chat and we'll get those answered.
Okay. Or you can come on, as she said, you can come on video or audio if you like. So what we learned in the years we've been working in Washington, D.C., trying to get members of Congress to understand family businesses is they don't understand family businesses at all. They really have no clue what you do, the jobs that you create, the economic activity you create. And so we encourage Congress to form a Congressional Family Business Caucus. We're very excited about this caucus. It is bipartisan, as we are. Both companies we represent are bipartisan. And it's an educational caucus. So it's not taking policy positions, which is important because we want to make sure we stay bipartisan. And if it was a policy caucus, that would be much more difficult to do. So as you can see on the screen, it has no specific legislative agenda and it is bipartisan. We host and support and organize and fund these fly-ins. We do 3 a year. We're on our 3rd one this year, as John talked about, September 18th. If any family business is interested in coming to that caucus meeting, we'd love to have you there. It's from 4 to 6 p.m. on September 18th. These are the co-chairs of the caucus in the House. We're still working on the caucus in the Senate. As you can see, we have 2 Democrats and 2 Republicans. They've been involved in the caucus, some more than others. Congressman Snyder from Illinois has been wonderful. He's come to every single caucus meeting, and Claudia Tenney has come to almost every single one. We have 50 members of this caucus, which may not sound like a huge feat, but it actually is. We're less than 2 years old in developing this caucus, and having 50 members in 2 years is really a huge feat. So we're very proud of that. I realize it's hard to see, but if you don't see your member on the screen, please reach out to them and ask them a simple ask. Please join the Congressional Family Business Caucus. It's bipartisan and it's educational. It's really that simple. So now I'm going to turn it over to Russ Sullivan with Brownstein, and he's going to talk to you about our political and tax changes that are going to happen in 2025. Russ?
Well, good morning, everyone. We have a lot to talk about. A lot is happening in the campaigns that's going to impact how policies, particularly economic policies on tariffs and taxes, will affect family businesses. We also have a lot happening in Washington just with respect to the state of the law. We'll try to get as much of that as we can. But today I'm going to try to connect for you the connection between election results and policy changes that occur. We're going to talk about significant changes that are going to happen in 2025. And for one of the only times in recent history, I'm going to explain to you why the tax law is going to change regardless of whether Congress is competent to pass something or not. Because if they don't pass something, your taxes are going to go up. If they do pass something, they might go up, they might go down, they might stay close to what they are. We're going to explore that. We're going to talk about the new developments in tax policy that particularly affect family businesses, particularly some of these wealth tax proposals. Try to explain to you what they are and our concerns, and we're anxious to hear your reaction to those. And then we have a beefed up IRS, which if you haven't experienced it, good for you. But I'm afraid we're going to have a lot more folks who've been successful entrepreneurs be addressed and reached out to by the IRS with more audits and more enforcement. So let's get started. I'm going to start with the little more on the election side and the recent developments, and then I'll frame how this fits in. We have a new presidential race. You're all aware of that. Vice President Kamala Harris is now the nominee for the Democrats. Donald Trump, the nominee for Republicans. Trump has been ahead in the polls. Vice President Harris has pulled close to even in the polls. But this race is very fluid and is going to be very close. Donald Trump attracts votes from independents and some Democrats. He also loses some Republicans. We're not really sure about Kamala Harris yet because she's very new and people are still forming their views of her. And she hasn't really even faced a press conference yet. So until she does some of those things, I think people's minds will be a little bit fluid. Next slide. We can talk about their tax policies. Trump's is more well-formed than Harris's. Trump's been clear that he wants to reduce taxes. He has said that one of his priorities will be to renew all the Tax Cut and Jobs Act tax cuts. Those are individual tax cuts and the tax cuts on pass-through entities. He also has recently said he's for lowering the corporate tax rate from 21% to at least 20%. He does have a really strong view on tariffs. If your business or your clients' businesses are in the manufacturing sector, you should pay attention to this. He would like to impose a 10% tariff on all imports to the U.S., regardless of what country they're coming from. And he would raise that to 60% on goods coming in from China. This would be a dramatic increase that could affect, could very well encourage the establishment of some U.S.-based manufacturing businesses. In the short term, however, it may increase the price of goods that U.S. businesses use as some of the basis, the feedstocks, some of their products, and also could have an impact on inflation. Recently, he's come out with two new proposals. One you've heard about on tip income. He stated he's for eliminating the income tax on that. Kamala Harris sort of embraced that in last week in Las Vegas and said, I'm for that too, when she has never been for that before. Trump also came out and said he's for eliminating income tax of Social Security benefits. If you're a senior, you know that most Social Security taxes benefits are taxed, particularly if your family earns more than $32,000 a year. I think this one is a less viable proposal because Social Security has special protections under the budget laws, and it would require a bipartisan majority in the Senate to actually approve that. Harris is less clear on what her overall proposal is. She basically says she wants a fair taxation system. What she means by that is she wants individuals who are successful and making more than $400,000 to pay more. She would like multinational corporations to pay more. And she'd like people on the lower end of the income spectrum to pay less. Now, to be honest, we're a little bit less sure because she ran for president in 2020, and there she had a very progressive agenda. She was for Medicare for all, a government-run healthcare program, and she funded that in part by an excise tax on all financial transactions, all investment transactions. She also imposed or proposed that there be a surtax on everyone earning more than $100,000 to help pay for her plans. But she's backed off some of that now, not totally, but she did embrace the Joe Biden pledge of not raising taxes on individuals making under $400,000 per year. As a result, she's basically promising to extend most of the Tax Cuts and Jobs Act that President Trump got into law in his term, because 2/3 of those tax cuts went to individuals who earn less than $400,000. But she's not for extending the upper rate tax cut and some of those that are on individuals making more than $400,000. She's for a robust child tax credit that's larger than current law. She has not fully embraced a corporate tax rate. She's hinted that she's for 28%, but her original proposal was for 35%, to go back to that rate. And she certainly embraced the Biden proposal to increase the capital gains rate to ordinary income levels. So fairly dramatic proposals there.
We do have a question that has come through, Russ.
Great.
How do we reconcile tax cuts with increased deficit spending? How are cuts to corporate taxes paid for? And worried that we're prioritizing short-term gains over long-term stability in these choices.
A good question. Pat, if you could go forward about maybe 5 or 6 slides. I think we have a slide number. Slide number 13, Pat. If you can, or whoever's got it, just flip through there. Well, I'm sorry. It's keep going. One more. There we go. The one before that, Congressional Budget Office. So that's a great question, and neither side has been exactly specific over what they would do, but let me give you the framework. To extend all of these TCJ tax cuts is going to cost over $4 trillion. In other words, there were a bunch of tax, they're really about 8 trillion in tax cuts, and then there were 4 trillion or so in tax increases. So they eliminated the deduction for exemptions for dependents. They capped the SALT state and local tax deduction. Some of those raised money that offset the tax cuts. But the Congressional Budget Office and Joint Tax Committee say it's going to cost about $4 trillion to extend them. They're different approaches. Democrats have said, we'd like to pay for those. We're willing to pay for all of those, and we're going to pay for them with tax increases. The Biden budget specified $5 trillion in increases on individuals making more than $400,000 and multinational corporations. So Harris could say, and is likely to say something like, if I were president, we would pick $4 trillion out of those and fully pay for it. Republicans have a different approach. Republicans have proposed different kinds of things. There are some that are saying, hey, we need to pay for these with some tax increases on specified individuals. For example, most Republicans are for keeping the deduction on SALT at $10,000 or even reducing it further. That could raise a significant amount of money. They're also going after college endowments, particularly those where they have very high endowment, but their tuition costs are high and they're not providing scholarships for the students there. Some also have proposals that relate to whether they allow free speech on both progressive issues and conservative issues on their campus. But other Republicans have said, no, we ought to pay for this with reduced spending. And the Budget Committee has put forth a wide variety of spending cuts that could pay for these tax cuts. And then Trump's tariffs, as he has proposed them, would actually raise about $4 trillion. So I think if Republicans win, they're likely to come out with a combination of tariff increases, spending cuts, and some targeted tax increases to pay for that. Hope that answers your question. Now, if we could go back to the slides before, we want to talk about the vice presidents and their records. We have 2 new people. We'll start with J.D. Vance, who's named the vice president for the Republicans. He does not have a really expansive history on tax proposals. I've talked about college endowments. He's for increasing that one dramatically. He is against the electric vehicles tax credit and other subsidies for electric vehicles, and he's introduced legislation for that. He supports the tariffs, and he has said that some large corporations ought to not be able to have exemptions from paying tax when they merge with one another. Whether Trump will adopt all of these, not clear, but they're fairly in line with what Trump has said as well. Next, for the Democrats, we have Tim Walz, who has just been named. When he was governor, or he is governor of Minnesota, but if he is elected, he will, during his tenure so far, he has raised the corporate rate to one of the highest in the country. It's 9.8%. He also did impose a 1% surtax on all investment income. So capital gains, dividends, if the individual has more than $1 million per year. He has expanded the child credit by implementing a state-based child credit. So in Minnesota, not only do families get $2,000 per child from the federal government, they would get $1,750 from the state government for low-income families. And interestingly, he embraced a version of what Trump has proposed, which is exempting Social Security income from state tax for certain individuals. When he was in Congress, however, he was much more moderate. He was one of the few Democrats who supported the American Taxpayer Relief Act in 2022, which extended some of the tax cuts from 2001. He did, however, oppose the TCJA, and he has long supported biofuels tax credit. Again, whether any of these ideas will be adopted by Harris remains to be seen. All right, so who's going to win the election? Well, nobody knows. Don't let anybody tell you that they know, because they don't. But there are 7 states that are most likely to decide it. I'm not sure we have folks from any of these states on the call. If you do, we certainly would like to hear your opinion. But these are states that Biden won all of them except North Carolina in 2020. But Trump won Pennsylvania, Michigan, and Wisconsin back in 2016. So they're going to be very close. They're going to go up and down between now and November. However, what we can say is with a little more confidence, we'll go to the next slide, is that Republicans are likely to take control of the Senate. The Democrats control it now by 1 vote, 1 seat, but we already have 1 state, West Virginia, that it's pretty clear that the Republicans will win that vacant seat. Jim Justice is way ahead of the Democratic nominee. We have a couple other states where Trump is going to win big, regardless of whether he wins nationally. He will win these states, Ohio and Montana. And there you have Democrat incumbents running, trying to retain their seat, and they may lose 1 or more of those states. In addition, Nevada, Arizona, and Maryland are states where it's going to be very close. And there's currently an empty seat, or there's a Democratic incumbent in those seats as well. So it's the best Democrats could hope for would be a 50-50 tie, which if they swept, won the White House and the House, they might possibly have all the levers of government, but more likely Republicans will be in charge. In the House, however, not as clear that Democrats will retake the House, but they probably will if the presidential race is close. Again, we have a very close margin right now. Republicans won it in 2022 by flipping about 15 seats in California, New York, New Jersey. However, I think Kamala Harris is going to bring out a disproportionate number of voters in California and perhaps on the East Coast, where people like her progressivism. And those people will be voting in districts for their member of Congress, and it'll be difficult for the Republicans to hold all those seats. But we have other competing factors. We have some cases where the courts have ordered redrawing of the districts. We have the census, which is finally fully taking effect in redrawing the lines. And so this is too close to call, particularly if the presidential race is close. If Trump wins by 6% nationally, yes, Republicans will win the House too. If Kamala Harris wins by 6% nationally, Democrats are going to retake the House. But if it's close, the advantage is slightly with the Democrats. All right, let's get to the legislation and how it can impact you. There are 2 things you need to know as to why this is especially important in 2025. Number 1, it's a historical fact that every new president gets a tax bill in their first year of their term. You can see the chart here. I've lived all the way and followed politics all the way back to Carter, but for purposes here, I'll start with Reagan. And except for George H.W. Bush, all of these presidents got a tax bill passed in their first term, early in their first term. For some, it raised taxes. For some, it cut taxes. For some, it did both. But they all got them passed. And the same will be true this next year. In 2025, there's going to be a tax bill that passes. In addition to that, tax bills generally pass when we have legislation that's going to expire. The next slide will show you that when we have significant middle class tax cuts expiring, that's when Congress leaps into action. It happened in 2010. I was in charge of taxes at the Finance Committee for the Democrats at the time. And while Democrats had opposed broadly the 2001 George Bush tax cuts, they changed their minds in 2010 and 2012, and they extended those very tax cuts that they had opposed. The same thing is already happening this time. both Biden and Kamala Harris, who criticized the TCJA, then during the last year or so have come out and said, oh, actually, I'm for extending the ones for people making under 400,000. So look at all the individual tax provisions that expired December 31st, 2025. The higher rates. The top rate would go from 37 to 39.6, but all the other rates would go up. In addition, the brackets were expanded at lower rates. They would contract again so that the higher rates would kick in at a lower level. We would have certain itemized deductions restored, but the increased child credit is going to expire. We go back to $1,000. There would be a tax cut for people in high tax states at the state level because the SALT deduction scheduled to end. But we also have AMT would come back in and would actually probably bite into that deduction for state and local taxes because that's the way it worked. The estate tax exemption will revert to a lower level, not exactly what it was before TCJA because the inflation factor stays in there. So it'd probably be about $7 million per individual, $14 million per couple. But in addition to individual provisions, again, those who are structured as a pass-through, the Section 199A deduction would expire at the end of the year. That deduction basically excludes from taxation 20% of the profits of pass-through businesses and reduces the effective rate for a successful business from 37% down to 30%, making it closer to the corporate rate. We've got R&D expenses, provisions that allowed current expensing of that. Now they have to be spread over 5 years. We have limits on deductibility of interest and bonus depreciation that have begun to expire. I think those issues are likely to be addressed next year as well.
Related to this, Russ, can
Yes.
we expect the Section 174 changes to survive?
Yeah, the 174 changes, I do think will get reinstated to allow expensing of the R&D costs. I say that because both parties have embraced that. It's not just the Republicans, but Democrats who chair the tax writing committees have both said they're for that. And so I would expect in a bill in 2025 a high chance of returning to current expensing of R&D costs. Now, Democrats are not as enthusiastic about the other two, the bonus depreciation and the interest expense. Bonus depreciation has stronger support among Democrats than deduction of interest expense. So I would rate them in that order. R&D is most likely, bonus depreciation second, business interest expense will have a hard time unless Republicans sweep and control all the levers of government, in which case I would suspect that one's going to pass as well. Good question. All right, the next slide we've actually already covered, so we'll skip that for now. Let's talk about what the tax reform will look like. If Republicans sweep, we're going to make permanent all or virtually all of the TCJA provisions. So that would include the 199A deduction, the state tax provision at 13 to 14 million, the lower individual rates and capital gains amounts as well. Now, I will say on this point, of these, the one that Trump has not embraced is 199A deduction. That one came in the Senate in 2017 with a group of senators who were fighting for family-owned businesses and other pass-through businesses, small businesses. And so I'm not sure why Trump has not embraced this publicly. I think he will eventually, and the members of Congress will push him to do so. But we'd like to see, both Democrats and Republicans embrace an extension of that. Again, I've talked about his being for the rate, corporate rate reduction and the tip income. I think Republicans are likely to repeal as much of the IRA as they can. This was the bill that had a lot of climate-related provision, both spending for efforts to reduce emissions, as well as tax credits like the electric vehicle tax credit, which does not have much support among Republicans. And then Republicans would scale back IRS enforcement money, which was passed in the IRA and the IRS has begun to use. If Democrats sweep, it'll look very, very different. So we'll have an increase in the child tax credit. I'm not sure what to, at least 2,500, but could be higher. I will note JD Vance just over the weekend or last week said he's for a $5,000 child tax credit. So maybe that's one where we will see escalating proposals from Democrats to try to match Republicans during the campaign. Democrats want to remove the SALT cap totally. They want to dramatically increase taxes on corporations, the rates. They want to expand some of their energy tax credits from the IRA. They do want to allow the top bracket TCJ income tax rate to expire and to go up to 39.6%. And then of significant concern is Democrats increasingly are supporting the imposition of, this is a version of wealth tax, but a mark-to-market tax on successful entrepreneurs. In other words, they want to tax annually the appreciation on assets, stock, bonds, other assets, real estate, other items that people invest in, and they would like to do that annually, which would be a dramatic change from current policy. This is, I will say, this is not yet a Kamala Harris proposal. She's not signed on to the bill. She didn't sign on to the bill. She hasn't embraced it, neither did Biden, but it's increasing in support. We'll come back to that in a moment. And then finally, what happens if we have divided government, which I do think is likely. On the next slide, you'll see what is likely to pass. First, we will have the extension of the middle class tax cuts, maybe some of the higher ones, but probably not all of them. We will see a real focus on encouraging domestic production. This will be done both by imposition of some tariffs, but also reducing tax incentives for foreign derived income. In other words, people may have to pay more U.S. tax on their foreign operations if they own subsidiaries that are located in other countries. There will be more promotion of domestic research and manufacturing. I talked about the research piece of it, that I think we could see some additional investment tax credits for manufacturing facilities that are located in the U.S. Certainly fewer incentives from anything coming from China. And then I think there will be some revenue raisers on what both parties deem as unsympathetic groups, like perhaps some institutions of higher education. But it'll be a smaller bill, and you're not going to know until the end of 2025. If either party sweeps the elections, they're going to try to move quickly in the first half of 2025. If we have divided government, they'll have to negotiate between each other, and it will take virtually the whole year to get to a resolution.
So Russ,
All right.
Dustin asked before we move to this section in the chat, who's going to pay these tariffs? Or is it going to be on the family businesses, or who's going to pay those tariffs?
Well, the tariffs technically would be paid by the importer. So it could be a customs broker, it could be the company that's importing them, could be the company that's selling them to the U.S. That would just have to be negotiated, but it will be paid as the goods come into the U.S. Trump will say that these are being paid by those who are manufacturing or creating the products overseas and selling them to U.S. Technically, I think that's true. But however, I think most businesses and economists will say, yeah, but we'll have to pay more for the product because they will insist that they don't bear the entire cost of the tariff and will pass along those costs to the businesses. Many businesses admit that they will be forced to pass along those tariffs to the ultimate consumer. So it could be individuals, businesses, whoever's using the product that ultimately sees an increase in the price of the product due to embedding the price of the tariff into the cost of the good. Great question. We'll probably see a debate on that during the fall, this fall of the campaign, as to who's really going to bear the cost of that. Any more questions?
Not so far.
All right, we'll spend the next few minutes talking about the new challenges to successful entrepreneurs. Democrats have fired up investigations of successful entrepreneurs. I mentioned before that Democrats say they're willing to pay for an extension of any tax cuts, tax credits, and all, and an increase in the child tax credit. They would like to do so on people paying would be multinational corporations and successful entrepreneurs. Well, Ron Wyden, who chairs the Finance Committee, has put forth a wide variety of proposals to increase taxes on successful entrepreneurs and family-owned businesses. We've had hearings in multiple committees trying to identify what they think are loopholes or what are situations that should be taxed that aren't currently taxed under the law. And then in addition to that, Democrats have put out some new proposals. Haven't received that much press, but if you look at the next slide, you'll see new proposals from the Senate Finance Committee Democrats on grantor retained annuity trusts, increasing the taxes on those, private placement insurance taxation, sort of deeming that those products are not really insurance and so shouldn't have the benefits of deferral associated with life insurance products, tax-free borrowing against personal assets. Senator Wyden has sort of gone against one of our Supreme Court justices related to borrowing against assets, claiming that that's really monetizing the asset and should be taxed at that time. There are limitations on retirement account holdings that Senate Democrats have proposed. And then finally, this tax on unrealized gains for millionaires that I mentioned earlier is mark to market. Let's bore down into that proposal a little bit on the next slide. Senator Wyden calls this the Billionaires Income Tax Act. He's saying he's seeking to tax currently appreciation and value of assets owned by billionaires. But if you look at the details, it's not just billionaires, it's millionaires as well. And we see that in the details of his proposals. In fact, in the trust realm, someone could have as little as $10 million in their trust and be subject to this tax on unrealized gains. Again, the issue here goes to liquidity. You're being taxed on a product or an asset that you may or may not be able to sell, certainly may not be able to sell it at its market value, its fair market value, if you had the ability to hold it and sell it at the appropriate time. But regardless, this is a dramatic change from our current tax principle where we basically tax gains on assets when you have a recognition event, when you sell the asset and you know really how much you earned. All the appreciation on assets prior to that time may or may not be real, depending on what happens in the market. So Senator Wyden says tradable assets will be marked to market yearly. If you have illiquid assets, which he defines to be real estate and certain other assets, he says we could defer the tax on that until it's sold, but we're going to charge you an interest charge. We're going to charge you interest as if you had sold the asset and recognized the appreciation annually, and then you're paying interest on that tax amount. So this proposal has now gained 18 co-sponsors in the Senate, and is a proposal that Senator Wyden will put on the table if the Democrats sweep the election as a way to partially pay for whatever tax bill is enacted in 2025. And so that's why we're very focused on these types of proposals, which family-owned businesses and others have told us that would be really harmful to their business plan, and would require dramatic restructuring or sale of their business. All right, finally, we'll talk about IRS enforcement. One thing is certain, the IRS is going to dramatically increase the audits. They got $45 billion over 10 years. They announced that they're not going to use any of this money to audit taxpayers with less than $400,000. Well, we also know that large corporations have the IRS sort of working out of their offices. They're audited year round and they're all audited. So who does that leave? Well, that leaves successful entrepreneurs who make more than $400,000. That's where they're going to focus their attention. And they've started to give some detail to that, saying they're focusing on partnerships, particularly complex partnerships, and others with pass-through income. They said they're going to use AI to help identify who they should target. The commissioner of IRS earlier this year, if you go to the next slide, said, we're going to focus on millionaires and billionaires who evade taxes. They're going to start with those who haven't filed tax returns. Then they're going to move to those who have filed returns but haven't fully paid all of their taxes. And actually, this slide is a little bit old. They've recently announced they've collected about $1 billion already from this effort. So we see this as something that you're going to have to deal with, even if Congress doesn't pass any legislation. Finally, I will mention a couple of things. One is we had an effort this year to pass some bipartisan tax legislation that would have done some things in the child tax arena and in some of the issues that we asked questions about earlier, the R&D. There was a bill that was fully paid for that would have retained current law in these areas. It passed the House overwhelmingly, but the Senate was unable to pass it, and it looks like it will not pass it this year. So those issues will carry over to 2025. Finally, just to remind you of the issues set to expire in 2025, the next chart repeats the items that we will be focused on in Washington, D.C. on your behalf. And these are basically the individual provisions as well as the 199A deduction. So with that, we'll open it up for other final questions or closing comments by my colleagues.
Please feel free to ask any questions in the chat or come off of mute if you have a specific question.
Hey, Russ, you may, if you can you just explain quickly, on mark to market for a family business? I mean, you're talking about having to have the business valued every year?
Yeah, there would need to be an appraisal every year in order to determine whether you'd had appreciation or depreciation in value of the asset, and you would use that as a basis to calculate how much you had to pay. Now, for some things like stock market stock that's held, maybe that's fairly easy. You can go to the price that's available on December 31 for that stock, but other assets it's going to be much more difficult.
So I would like to add for everyone that's listening what John Gugliada said earlier. You all heard now that the estate tax exemption is going to be cut in half in all likelihood. It's now at an all-time high, as long as Russ and I have been working on these kinds of policies for a very long time, at 13 million plus per person. It's very likely going to be cut in half. And so if you have not done your planning, you better call your estate attorney today, and they're all booked up. The ones we're hearing aren't even accepting new clients. So it's really, really important that you do as much planning as you can possibly do. The reason that we're concerned about TCJA expiring, as Russ talked about, and what provisions are going to actually not expire or be renewed, is because, as he mentioned, it's $4 trillion to keep all of those tax provisions permanent. And I don't think Republicans or Democrats are going to vote for that. So it's really, really important. We're going to be playing a lot of defense, hopefully some offense, and fighting to keep as many of these provisions that help family businesses as possible. But we need your voice. And so please, as John Gugliada said, we have this caucus meeting. It's very important, September 18th. It's on the Hill. It's actually in the Longworth office building from 4 to 6. 4 to 5 is the meeting, 5 to 6 is reception. We have members of Congress, staff members. We have a panel of family business owners speaking. We have not only people in the room, but we also have it. We record it, video, audio. and we send it out on social media, our YouTube channel, and everywhere else so that we can get our message out. We really need family businesses' voice. Otherwise, I'm really, really concerned what's ultimately going to happen.
And if I could add to that, Pat, before Stephanie gets to this next question, if anybody belongs to a trade association out there that they feel wants to be involved with what we do, we have just started this program where we're collaborating with a lot of trade associations and educating their family business members on the issues that we've talked about today. So if you feel you belong to one that could benefit, please let me know. We're happy to do that. We actually have, I think he's from Associated Equipment Dealers is going to be on our panel in September. So, feel free. We want to continue to educate folks on these issues. So happy to take any recommendation of a trade association that may want to be involved with us.
And I participated in a caucus meeting last year. Really informative, and especially if you are someone who's very passionate about the issues affecting your business and your family, your voice will be heard very well.
Thank you, Stephanie. We appreciate that. We have 2 questions in the chat. I'm going to go ahead and read them because they're somewhat related. Russ, I think you're the one that probably should answer them. They both relate to the wealth tax or the billionaire's tax. So from Peter, we got with the mark to market, if there was a depreciation rather than appreciation from a year to year to next, would the business receive a credit under the proposal? And then kind of along with that, does the mark to market include shares we own in our own private businesses? And then in the years of growth, would that force us potentially to sell our own ownership to pay taxes?
So the answer to both questions is yes, with sort of asterisks. So Senator Wyden has stated, and some of his materials say that his goal here is to tax appreciation, but he understands if the value goes down, that there should be a credit for that against other taxes. What he doesn't prescribe, though, in all the details is how that would interact with like current law limits on capital gains, losses. There's currently a $3,000 limit that you could take per year. And it's not clear that he's overriding all the other limits and limitations in the code against sort of monetizing that depreciation or that loss. So we're very nervous about how it would come out in the legislative drafting that the legislation would experience as it goes through Congress. On the mark to market, if the shares you're talking about are you own individual shares in your business, then yes, if you're subject to the tax regime, in other words, you have millions in income or millions in assets or billions in assets that are the standard, then those would be subject to the mark to market regime. And again, if it's stock, it's considered to be liquid. So that one would be one that would be taxed annually and you would have to pay. Another reason to be concerned about this legislation.
Great questions. If there's any final as we wrap up here, we have another question. Russ, do you provide any historical data when you present survey results to Congress? For example, the survey indicated businesses would reinvest in their company with tax cuts. I'm wondering if history shows that's true.
I'll answer that question. That's the first time we asked that question. So we don't have any history on it, but we'll definitely ask it again. And the reason that we asked it is because we have one of the members of the caucus is Representative Sherman from LA, who's a very interesting member of Congress because he is a Democrat, but I think he thinks, and he tends to be more of a liberal Democrat, but I think he tries to make good solutions for our country. And he asked that very question. So we suspect we're going to get similar answers year after year. But again, this is the only year we have answered that question. But it's very, very important because what we want to show legislators is family businesses are going to reinvest in their business, in their employees, and in their community.
When can we expect the survey for next year?
We usually start the survey in mid-December and then it goes through the end of January. So Stephanie, we'll be sending you a link probably in December or early January. We like to get it out as quickly as possible. And as John mentioned, I think his goal for this year, because he's the one that does all the heavy lifting on this, is to get over 1,000 respondents.
Great. Well, we appreciate all of our families who contribute to that survey. That data is very important, especially representation from Prairie Family business members.
Absolutely. We also appreciate them very much.
Thank you so much for today's call. This has been very informative. We appreciate all the insights, and there's some action that families need to be taking, whether that's meeting with your estate planning attorney and getting some updates done, timely updates, or talking to your representatives and getting in their ear and their voice on what family business issues are important to you and your community. Thank you so much. We appreciate it. Pat, Russ, John.
Yeah, thank you, Stephanie, again for the opportunity. Take care, everyone.
Thank you, Stephanie.
Thank you.